I think the Fed is way behind the curve, way behind the growth curve. It's not evident now. It's evident in the work that we're doing. And the longer they wait, the more they're going to have to do. But next year will be the exciting story. When they see the whites of the eyes of the recession, when they see inflation coming well below target, they'll be cutting rates aggressively.
David, thank you very much for joining us today. You and I both reside in the city of Toronto, and I do want to talk to you about the Canadian economy and also the housing situation. But before we do that, I want to first focus on the U.S. It is the largest economy in the world with a GDP of $25 trillion. And because Canada is so close to the U.S., whatever happens there has a big impact on Canada. And when I look at the U.S. economy, to me, it looks relatively good. The GDP continues to chug along, even though the Q1 GDP number was revised recently from 1.6 down to 1.3, but the jobless number is also good, below 4%, and it has been now for many quarters. Inflation continues to track lower, heading toward that 2% target rate of the Fed. And of course, I have to talk about the U.S. stock markets. The S&P and the NASDAQ continue to make new highs every other day. What is your view of the U.S. economy? Is it as good as we're led to believe it is?
The answer is that the U.S. economy is, it's like a mirage, okay? So I know that all the statistics that you had mentioned sound like they have a rosy glow to it. But the question is, why was the U.S. economy last year? Like, it's not strong this year, right? Like you mentioned before, 1.3% growth. And second quarter, it looks like it's coming in even slower. So we're down to a 1% growth economy. And if we're going to call that strong in the United States, I guess we have to redefine what the term strong means. And then the question is, where do we go from here? Is there going to be some sort of reacceleration? We were 3% last year. We're down to 1 plus. And is that a trend? Because if that's a trend, from 3 to 1 to then what? What's the sequence? And if you believe that this is just noise, what's happening this year, then the question is, what's the source of the reacceleration in the beloved and wonderful U.S. economy? Here's the story about last year's 3% growth. Here's the story about why people calling for a recession, I'm not going to say they got it wrong. They got the timing wrong. Didn't get the concept wrong, okay? Last year, all that 3% growth came from two things. Massive fiscal stimulus, okay? The Biden the CHIPS Act, the oxymoronic Inflation Reduction Act, which never did reduce inflation, but we had tremendous spending in the United States last year on the public sector side. So the fiscal deficit last year expanded 25%. You mentioned before the unemployment rate's below 4%. Why on earth would the government expand its deficit by 25%? Why would you do that? So it's a false glow from the government sector. And then on top of that, we had the consumers continue to draw down all those excess savings they had from the $2 trillion Joe Biden giveaway, the fiscal stimulus checks in March of 2021. That was a gift that kept on giving. You can't spend $2 trillion in a month or even a year. That had an impact right into last year. And that's why the U.S. personal savings rate is down almost 3% today. Americans are saving barely more than 3 pennies from every after-tax dollar that they earn. So I guess there was a bull market and narcissism. There certainly was a lot of consumerism and a tremendous amount of government support. But you strip out the excess savings story, which is now in the rearview mirror, and you strip out the fiscal stimulus, GDP growth last year was 0. And people will say, Dave Rosenberg, you're mining the data. You're mining the data. No, I'm just providing some analysis that this is not a house of brick. This is a house of straw. And look what's happening now, because I think that your first comment was looking at the economy in the rearview mirror. Last year was a 3% growth year, and we talked about why that was the case. What's happening this year, down to a 1% growth economy in the world's largest economy. And people still think that the U.S. economy is strong because they're extrapolating what happened last year. We're already We're already heading into June. We're already in June. And people are still talking about a strong economy. We're barely more than 1% growth. And the unemployment rate below 4%. The last time the unemployment rate in the United States was below 4% for this long was in 1969. And people are saying the same thing. Miracle. The miracle on Main Street. But we had a recession in 1970 that caught a lot of people by surprise. The unemployment rate is a lagging indicator. For the viewers of this show that are investors, please let the social workers focus on the unemployment rate. And if you're an investor, treat it as a lagging indicator because it's not going to help you in your investments in the next 12 months. Lagging indicator. It's always at the lowest point before the recession starts. And it's always at the highest point. You see, we'd be talking here in 2009 and you'd be saying, oh, woe was me, the unemployment rate is so high. That was when the recession ended. So you treat that unemployment rate, if you're an investor, as a contrary indicator. The fact that it's as low as it is not something you'd wave in front of investors saying, this is great news. Okay, because it usually marks the end of the cycle.
So we just had one revision from 1.6 down to 1.3. Would you expect another one? And it seems like we're seeing a lot of revisions in these economic numbers. Why are we seeing so many revisions?
Well, firstly, you're 100% right, 1.6 to 1.3. Will it get revised down again? That's hard to say at this point, but 1.3%. All we're hearing in the United States is about the wonderful unauthorized immigration. A big immigration boom going on in the United States. It's generating 1.3% growth. I got news for you. Second quarter we're in, looks like it's going to be even weaker than it was in the first quarter. So we have a trend here towards squishy soft. You'd say, well, it's not a recession. 1% growth, okay? You're on some pretty thin ice. On the revisions, well, there's a reason why you're seeing these downside revisions. A lot of it speaks to the veracity of the economic data coming out of the government. And a lot of that's because of the low response rates that we get in the initial samples since COVID. And it's affecting every country, but it seems in the United States that the quality of the data has really deteriorated. And I'm not a conspiracy theorist, but the revisions are breathtaking. And you see what happens is that you get a decent number in February, and you think the economy is great. Then when the March data come out and they revise down February, you forget about the fact they revised down February. And then the March data that comes out in April, that gets revised down. But a month earlier, it looked really strong. And that's what I mean. It's almost brainwashed people into thinking this economy is really strong. As you just said, 1.6 to 1.3 on first quarter GDP growth, but every number is being revised lower. Every number, all the housing indicators, retail sales, industrial production, you mentioned employment, non-farm payrolls. All these data are being downwardly revised. And we actually just published a report, and we constructed a revision diffusion index and took it back in time and looked at it over 6-month intervals so we didn't get caught by month-to-month wiggles and a lot of noise. And we're looking at the pattern of these revisions because these revisions have a lot of information. People tend to forget. People thought the economy was strong in January, but the post-revised data aren't so strong. Same in February, same in March. The data are being revised consistently lower, but because people judge how the economy is doing by looking at the wonderful stock market. The stock market is not the economy. The stock market is all about investor enthusiasm and animal spirits. It's not the economy. People tend to forget the stock market peaked in October of 2007. The recession started less than 2 months after that. That's the wonderful thing about the stock market. It's not a leading indicator of anything. It's a coincident indicator of investor confidence. And that's really all it is. But back to the economy, these downward revisions feed on themselves. They're very, very pro-cyclical. And we found that when you're coming out of recession, when you're going into the expansion, the data are being consistently revised up. And that's an early sign that the worst is over. But we're on the other side of that mountain because what's happening now is the revisions are consistently worse. And we looked at this pattern, and it looks just like it did in 2000 and just like it did in 2007. And in 2000, we're just talking about technology and wonderful stock market and no recession ever again. Well, I got news for you. Recession started in March of 2001. And then back in 07, we're looking at the pattern of these revisions. They look exactly the same today. 07, who's calling for recession in 07? Nobody. Started in December of 07. So it's giving us a view of the economy that's a little different than your introduction, that things are actually not what they appear to be at the surface.
David, you mentioned that one of the reasons that the U.S. economy has been so strong or was so strong was because of the fiscal policy and the trillions of dollars that the Biden administration has been spending here in the last few years. And when you look at that, when you look at the national debt at $35 trillion, it's growing by $1 trillion every 100 days, which is just a mind-boggling number. And then you look at the interest payments associated with that. I believe the U.S. government paid over $800 billion in 2023. That number is going to be over $1 trillion in 2024. Is this concerning to you in this excessive debt and the interest payments associated with it? Because a lot of that debt's going to be coming up for refinancing.
Right.
It's not going to be refinanced at 25 or 50 basis points. It could be 4 or 5%. Right? Does this concern you, and how does it get resolved?
Well, it reminds me of what happened in Canada, back in the early to mid-1990s. You reach a point where the interest payments on the debt start to ensnare the whole situation. And I look at that actually as a very deflationary situation. Deflationary. Because the interest payments ultimately crowd out other spending that actually goes into GDP. And that's a big problem, is that the interest payments are competing with everything else. So yes, we had some very nice fiscal stimulus spending. It's in the rearview mirror, but the interest payments on the debt continue, even as the spending that gave the economy the boost ends. And this is perpetual. And it's perpetual drain on fiscal finances, but the most important thing is that it is a deadweight drag on aggregate demand. You don't want to go back to the Canadian situation. Ultimately, the interest payments got so large that Chrétien and Martin had to tighten the belt significantly. And inflation went down, interest rates went down, even with that gargantuan level of debt, because the interest payments forced the government into fiscal austerity. That is staring America in the face. The most obvious example is Japan. Look what happened in Japan, for decades. And this is what happens when governments run up debt that is just plain too big relative to the economy. And even in the world's largest, most sophisticated economy, the United States, what's happening, as you said, $1 trillion of interest payments. That does not go into spending in goods and services. That is like I said, it is a deadweight drag on aggregate demand, and it's going to be an ongoing problem. And it's got to be stopped, arrested, and maybe by whatever new government we get on November the 5th. And ultimately, Congress has to also take action. It can't just be the president. But it has to be arrested because the demographics are a ticking time bomb. And you're competing against Social Security and Medicare, and the interest payments are going to crowd out along that spending. So yeah, it is a huge problem. It's not going to produce some, catastrophic results. The U.S. is not going to default. However, it is going to impair economic growth, just like it did in Japan for the past several decades, and as it did in Canada back in the 90s. This is actually something that reinforces my slow growth disinflation view for the next several years in the United States.
So let's talk about inflation now. Inflation peaked out in 2022 at 9.1%, and it is trending lower. But we recently saw a CPI number. I believe it came in at 3.6%. There was other components of that I thought were relatively high. The one that comes to mind was shelter at 5.5% year over year. And even though these are Argentinian-like inflation numbers, which is running at 300% right now, but they still seem high compared to what we had or what we're used to. And what are your views on inflation? Is it tracking lower, or do you think it's starting to reignite again?
Yeah, it is definitely not reigniting again. And we had just a small deviation in the opening months of this year for two reasons. Shelter was one of them, as you'd mentioned, we'll get into that, but also insurance premiums, health, property, autos the most. Auto premiums are going up 22% year over year, in direct response to the horrible claims experience by the insurance companies. And they've been putting through premium increases. Is that real inflation? Is that inflation that is signifying some sort of buoyant, demand-led economic growth? Or is it really a de facto tax? Health insurance, a de facto tax. Insurance is going up for a variety of reasons, but it's not the sort of inflation that you get from a overheated economy. And there's a difference. It's like if my property taxes go up. Is that inflation? Or is that a drain on my disposable income? It's not inflation, because it acts as a tourniquet on everything else I want to spend on. Now, you mentioned the shelter component in the United States. Only the United States, the only country in the world where they have something called OER. You know what I'm talking about? Owner's equivalent rent. 27% of the CPI comes down to one question in the survey to the sample of homeowners. What do you think you can rent your house out for? That's your inflation. That's your inflation. It's ridiculous. And it's 27% of the index. Now, Canada doesn't have OER. Canada, of course, well, it's also quite bizarre that in Canada, what's in the CPI is mortgage interest. So that's something that's bizarre, but it's different. Let's talk about the U.S., since you brought it up. Owner's equivalent rent. And I don't know if the viewers on our show are going to know what I'm talking about, but that is the biggest share of the consumer price index. And it's the primary source of inflation. The Europeans don't include OER. And there's something called the Harmonized Inflation Index that they use in Europe to compare Spain to Italy to Greece, to all the countries in the euro area. You can do that in the United States too. You know that when you put the U.S. inflation rate on the comparable apples-to-apples comparison to Europe, core inflation is running at 1.9%. It's running at 1.9. The Atlanta Fed actually does all the great work for us. They produce every month what's called a sticky CPI and a flexible CPI. And the sticky CPI is stuff that never goes down. It's sticky. I hear this all the time. Oh, inflation, it's sticky, 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 sticky. Well, there's some things that never go down. You could have a depression, education. Tuition doesn't go down. Healthcare doesn't go down. Those rents you're talking about, they don't go down. They'll slow down, they don't go down. So the sticky inflation in the United States is running 4.5%. But the stuff that moves with the economy, the stuff you can see, touch, and feel, the cyclical services, the amusement parks, the movie theaters, the sporting events, the airlines, and all the stuff. We're talking about clothing, and we're talking about building materials and furniture and appliances and electronics. That goes in the flexible. It's called flexible CPI because it moves with the economy. So this is the Atlanta Fed. The flexible CPI, the core flexible CPI, running negative 2 months in a row. It's running negative 0.9. So the stuff that actually has anything to do with the economy, that's why I come back and challenge you about how great the economy is. How great could the economy really be when the stuff that is most sensitive to GDP is deflating negative 0.9. We haven't seen that since August of 2020, when we thought we'd never emerge from COVID again. And the sticky stuff, now I say, yeah, that's a bit of a problem. But the sticky stuff is not anything the central banks can do anything about. What is the Fed or the Bank of Canada going to do about insurance rates? Well, the regulators might have to do something about that, but what is the interest rate? What is the interest rate that's going to buckle health insurance or property insurance? Is there an interest rate that will cause that to go down? It's nothing to do with the economy, but the stuff that has to do with the economy is actually in deflation.
Is that good or bad?
Well, is it good or bad? It's a symptom of an economy, as we said before, that is weaker than many people think. So it's really, I'm not going to say it's good or bad. It's a signal. And if you look at the year-over-year trend in that flexible CPI, you'll see that 10 times in the past 60 years, it's got into deflation. It's not the end of the world, but it tells me I got to be bullish on bonds, because this is actually very powerful stuff. It's telling you they were probably going to have a recession. The sticky stuff, like education, health, the stuff that never goes down. It's not gone down once in the past 60 years. It never deflates. But there's no economic information there. There's no economic information there. In fact, I would argue that because of the sticky inflation that's acting as a drain on purchasing power, is causing the deflation in the stuff that people don't have to buy, because you have to buy the insurance. You're not going to buy insurance. You're not going to drive your car. You're not going to insure your home. You're not going to rent. You're not going to send your kids to school. That stuff you can't substitute away from. It doesn't move with the economy. That's why it's called sticky. But it's taking away from stuff you might want to spend on movies and on travel and on tourism, the fun stuff, on a new suit. That's what's deflating. So the inflation in the sticky is causing the deflation in the flexible. And what comes out of the wash is a decisive downward trend in underlying inflation, especially the inflation that matters for the economy. So I'm not going to make a normative judgment. Is it good or is it bad? It is what it is. What I try and do is find anomalies. I try and find, as an economic detective, what is the truth behind the veneer of the headlines? And it's telling me a very interesting story here about how to approach the economic outlook. So that's how I'm treating it.
So another large component of CPI is energy, and I am surprised that energy has been vacillating between $70 to $80 a barrel, in spite of what's happening in the Middle East, and also the fact that we're going into the summer season when the price of gas tends to go up. But do you think this low oil price is indicative of a weakening economy?
I do, and it's a great point. And it's not just the fact that what's interesting is that the people, the gurus that actually follow the oil price, were telling us months ago we were going to cross over $100 a barrel. Where's the $100 a barrel? Where is that? We're at $77 on WTI. With all the geopolitical and what's happening in the in the Red Sea and the output cuts, the extension by OPEC plus, what's that telling you about demand? And here's what I might be telling you, that the global economy from a demand perspective is weaker than it seems. And it's probably telling you something about China. Remember, China consumes half the world's resources. Now, you've had some short squeezes in copper, had some impact on some of the other base metals, but nothing is more important than oil. And it's telling you something. The fact that oil can't rally even with the extension of the OPEC production cuts is telling you something about what's happening on the demand side. And primarily, that things in China are probably a lot weaker than they appear as well. And those are your two biggest economies.
So let's talk about interest rates now. When the Fed has been on hold since July of 2023. When we entered 2024, everybody was expecting 6 cuts. And then as we moved through the year, that went from 6 down to 3. Now people are talking 1, or some are even saying none. What's your take on interest rates? Are we going to see a cut this year?
Oh, I think we'll see a cut this year. I would say that. I wouldn't even take July off the table. The expectations have been all over the place, but the Fed's been all over the place. The Fed actually did have 3 cuts in their dot plots at the end of last year. Now, the market front-run the Fed, priced in 6, because some of the Fed officials were sounding pretty dovish. And they were never going to cut rates as early as March. There wasn't going to be enough information, and the markets did what they usually do. They overshoot. We're priced for barely more than 1 cut, and not till later in the year. We'll get a fresh set of dot plots from the Fed at the meeting in June. And we'll see, but it's situational. We actually have seen what J. Powell was talking about, which was his hope, which was that the inflation deviation this year from the disinflation momentum of 2023 was actually an aberration. And inflation is coming back down again. and we got a great PC deflator, which is actually what they do target. The market-based PC deflator to the second decimal place was 0.17% in April. That was a sensational number, and the bond market certainly liked it. And we're going to be getting some employment reports. And what if the unemployment rate climbs above 4%? The Fed's peak for this year is 4.1%. We're not that far away. What if we're 4.2? I think you'd still tell me, well, it's still historically low. And I would say, well, we're already above the Fed's forecast for the year. And their forecast for the year is 4.1 with 3 cuts. So, ergo, why would you be cutting rates once? Or maybe people are saying they're not going to cut at all. Why? So I think that the Fed, look, it's a case of once burnt, twice shy, and they're like deer in the headlights after missing transitory. Well, transitory in the overall scheme of things, 18 months in the overall annals of economic history, probably was transitory, but you see, they were shamed. The Fed was shamed. Fed was shamed. And it's true. He even talked about confidence. We can only cut rates when we have confidence. So they've lost confidence. I don't think they should be deer in the headlights. You know, they made a mistake. We all made mistakes. It was the whole world made a mistake. They stayed too easy for too long, and now they're going to stay too tight for too long. I guess that's the nature of the Fed. They're human beings. They're not machines. Will they be cutting rates this year? Yes, I believe they will be. They're playing their cards close to their vest. But I think that we're just a couple of really more good inflation prints, higher unemployment. It's not the level of employment that matters anyways. You know, people say to me, we'll be at 4.5% unemployment. The people will say, oh, still so low. And I'm going to say, yeah. And it's up almost a percentage point from the cycle low. And guess what? It's the change in the unemployment rate that determines the recession, not the level. We're at 4.5% or even 4.2, 4.3. We'll be in recession at that point. And people will still be pointing to the low unemployment rate to justify their bill of fuel in the economy. They won't even realize that we're back in the spring of 2001, or that we're in somehow the opening months of 2008. They'll still be playing by the old rules of positive economic growth from last year. That's the most dangerous thing people can do, is extrapolate. But that's what they're doing. I think the Fed is way behind the curve, way behind the growth curve. It's not evident now. It's evident in the work that we're doing. And the longer they wait, the more they're going to have to do. I could be wrong. Maybe they don't cut rates this year. Maybe the hawks, they're so hawkish. They're so nervous about cutting rates. They're so nervous about letting the inflation genie out of the bottle that they don't cut rates, which means that they'll probably plunge next year. I think they're waiting way too long. I sense that they'll be going maybe twice. They're not, but next year will be the exciting story. When they see the whites of the eyes of the recession, when they see inflation coming well below target, they'll be cutting rates aggressively.
So let's talk about the U.S. consumer now. See, now consumption represents 70% of GDP. And the TSA recently announced that over the Memorial Day weekend, they screened 3 million passengers in one day. All-time record, okay? So people are out there moving around, they're traveling, flying all over the country. And then Liveband, which is the parent company of Ticketmaster, recently came out with their Q1 numbers, record numbers. And they're saying this year, 2024, is setting up to be a record year. People are out there spending money on concerts. But then we saw numbers out of Starbucks, Q1 numbers lower than expected. They cited weakness in both the U.S. and China. Those two markets alone represent 60% of their revenues. And so we have a bit of a dichotomy here when we look at these companies, right? And people are spending money on travel, they're spending money on going to concerts, but they're not spending money on coffee. How do you make sense of this? What does this tell you about the U.S. consumer?
It's more than just coffee. I mean, take a look at the whole gamut of retailers. The numbers have been horrible. Same-store sales are negative. They're missing on the revenue line. I mean, a lot of the good news that you've been hearing has really come mostly out of the tech sector, but retail has been horrible and way beyond Starbucks. And people, I guess you could say that there's still some of that Biden stimulus money that's left in the system, and people post-COVID of, it's basically YOLO. You only live once. So experience spending, I suppose, which is a fraction of a percent of total consumer spending, I guess that part of it is still holding up well. Most other aspects of retail sales are actually in decline right now. The consumer is struggling. You have what's called a K-shaped consumer, a K-shaped economy. The high end is hanging in well. Who's going to the concerts? High end people. The big rollers are going to the concerts, or the kids of the big rollers. Most people can't afford the concerts. So I guess part of that is the stock market, making a ton of money in the stock market. Send my kid off to Vegas with his friends and whatever. There's that going on. So yeah, there's the stock market wealth effect, some lasting impact of those Biden stimulus that we talked about before. But the low-end consumer is getting crushed, right? The low-end consumer, they're the ones that have all the debt. They're the ones that, the high-end guys, they don't have the debt. The low-end guys on their credit cards, and the credit cards get reset automatically. They're auto loans, right? The interest payments on the debt, we were talking before about the government sector. What about the personal sector? And by the way, the business sector. And now this debt's coming due and everybody's rolling over, not just Uncle Sam. Just so happens that Uncle Sam has taxing power. But Joe and Jane Main Street don't have taxing power. They're hurting. And I hear this all the time. Oh, well, but most of the spending is done by the high-end consumer. Yeah, but recessions aren't about levels. They're about change at the margin. And the high-end family is not the ones that lead you into recession. It's the little guy. And it's not just that they're cutting back on discretionary spending. Everybody, even the high end. I'm hearing stories about how you're seeing Porsches parked outside the Walmarts now. Okay, you're talking about people buying private label away from brand names, buying more chicken, less veal. You're seeing even at restaurants. You're hearing more and more of the restaurants talking about plating. You know what I mean by plating? Yeah, you're basically sharing plates. Not ordering a bottle of wine, just a glass of wine, and splitting dessert. This is the changes in consumer behavior that happened just ahead of the economic recession that nobody wants to talk about because it's like a medical diagnosis. So recession, I don't want to talk about it. It's part of the business cycle. And I talk to people that manage money for a living, and I say you got to be prepared for it because it has significant impacts on your portfolio. But you're seeing a lot of shifts at the margin in terms of people's spending patterns coming in one word, frugal. And we're seeing that pretty well across the board, except admittedly at concerts and live entertainment. That much is true. That might be the last man standing.
So just to summarize everything you said about the U.S., you think the U.S. economy is a lot slower than what we're led to believe, and it might be coming to a screeching halt. Inflation, because of that, inflation is also coming down and it's going to hit the 2% target.
Yep.
Not this year, next year for sure.
That's right.
Interest rates, we're going to see a cut in interest rates. We just don't know when. But bottom line is the Fed is behind the curve.
Absolutely. Your question was great. It's like throwing darts against the wall. When are they going to start cutting rates? It's shifting all the time. We got some really bad employment numbers and inflation. Next thing you know, it's like, that was actually an early year skew to the day that everybody nervous about inflation. Next thing you know, by the meeting after the election, they're cutting 50 basis points. I don't know the timing. I'm not that good, but I know the destination. And it's going to be towards much lower interest rates than what's currently priced into the markets. That's why I'm bullish on bonds.
Okay, let's talk about Canada now. And the Canadian economy, relatively small compared to the U.S., 2.5 trillion, so 1/10 the size of the U.S. What's your view of the Canadian economy?
I actually think that we may be in a recession already. I think the year-over-year trend now in real GDP is 0.6. 0.6. It's basically not significantly different than zero at a time when the population is running over 3%. So real per capita GDP. We're looking at the economy on a per capita basis, which we should. We are in real decay. But on top of that, I'm looking at the unemployment rate and not the level. I'm looking at the change. And the unemployment rate in Canada in the past year is up 100 basis points to 6.1%. You know, the unemployment rate in Canada is higher now than it was before COVID. Unemployment rate is higher now than it was before COVID, and the Bank of Canada before COVID had the policy rate at 1.75%, not 5%. Unemployment rate is higher. We have more slack in the labor market now. But I'll tell you this much. In the past, when the unemployment rate is up 100 basis points in the span of a year, you're heading into recession almost 100% of the time. So things here, whether you want to get technical, call it a recession, not a recession, the economy is significantly weaker than it is almost anywhere else in the G10. So if it's not a recession, it's pretty damn close. And much weaker than it is in the United States. That much we know with clarity.
So that begs the question, why? I mean, we live beside the largest economy in the world. Why aren't we reaping the benefits that they've seen in the last few years?
Well, what's the benefits in the U.S. in the past few years? Rampant fiscal stimulus. Rampant fiscal stimulus. There wasn't rampant fiscal stimulus in the last federal budget in Ottawa. We could argue about whether it's smart to, de facto raise capital gains tax rates. I wouldn't advise it, but there's no stimulus in that budget, really, on that. We haven't had a stimulative budget in Ottawa in a few years. We had a pandemic response, but the Biden team went wild. And I'm not trying to play politics here, but there's no country in the world that's kept on stimulating through fiscal policy. Let me ask you the question, does Canada have a CHIPS Act? Are we bribing other people through subsidies to set up manufacturing facilities in Canada so that Canada will become the next great semiconductor power? But that's what Biden's doing. All the subsidies, tax breaks. Canada didn't have a 25% expansion of the fiscal deficit last year. The United States did. So you see, you can paper over a lot of problems, camouflage things with rampant fiscal stimulus. That's the United States story. As great as things are, NVIDIA and the whole generative AI craze and all the enthusiasm, the U.S. economy, without the help of the government, there was 8.03% last year. We didn't have that fiscal stimulus. And on top of that, we had a huge interest rate cycle here. Now you're going to say to me, well, they had that in the United States too. Yeah. However, everybody locked in at the lows. All the homeowners. There's no 30-year fixed rate mortgage. There was no 30-year fixed rate mortgage in Canada. The mortgages roll over much more quickly. Canada is much more interest sensitive than the U.S. economy is. Now, over time, those entities in the United States will be paying those higher interest rates, but it isn't happening immediately because they've locked in. So when you're taking a look at what Canadians, say consumers, are spending on interest payments out of their income, it's much higher than it is in the United States, and it's gone up at a much faster rate. So right now, 15% of total after-tax income amongst Canadian consumers is being siphoned from your paycheck to the local bank to service your debt. And that's the same ratio that we had before each of the past 4 recessions. So those are the principal reasons we haven't had a fiscal thrust here. But most importantly is that the economy here is forced to respond much more quickly to interest rate shifts than is the case south of the border. Look, in the United States, as you correctly said, we're almost 3% year-over-year growth. It's a lagging indicator. But in Canada, it's 0.6. Look at that gap, 0.6 to almost 3. And that's why the Bank of Canada is going to be forced to cut rates quicker than the U.S.
So you made an interesting point about the Canadian housing market and how we can only get a 3- and 5-year mortgage in Canada versus the U.S. where they can get a 30-year mortgage and lock it in. Do you expect a major reset coming when homeowners have to go and refinance at a significantly higher rate? And when I say a reset, I mean a huge shift in the Canadian housing market where you see prices drop 10, 20, 30%?
Well, I don't think home prices will go down by that much. And, a lot of that is going to be dependent on, will there be a change in immigration policy? Don't forget, there's supply and there's demand. And we're getting, population growth over 3%, 1.2, 1.3 million immigrants coming in. That makes population growth that's not driven by fertility rates or birth rates. If you have natural grown population, a baby needs a pacifier and a crib and a bottle, okay? These people coming into the country, they need a roof over their head immediately. So they create an automatic source of demand. And that's why we've had this upward pressure on housing inflation, even with interest rates where they are. So, you'll say, well, my kids can't afford, they're still living in the basement. They can't afford to buy a home. And you hear a lot about that. But that's one of the things about having too much of a good thing, when too much of this immigration is created a lot of this upward pressure, because they have to, either in the rental or in the owner-occupied space, they need a roof over their head immediately. So that's part of that problem about house prices not coming down, 20 or 30%. Maybe they'll come down 10%. What we do know is that we have a social problem in this country, and the social problem is affordability. Homeowner affordability is 40% more stretched than it's been on average in the past. That's a big problem. And how is that going to be rectified? Because the home ownership affordability ratio is a mean reverting series. There's only three variables: home prices, as you correctly said, income, that's the denominator, and interest rates. How are we going to get that number? And that's why I think that there might be some home price decline. I don't think it's going to be cataclysmic, but I think that home prices will probably adjust lower, especially in a recession. But interest rates are going to come down a lot. That is going to be the equilibrating factor, is much lower interest rates. And that's how we'll get some stability back. And keep in mind, we want to get more supply. People say, well, the Bank of Canada cuts rates. Well, it's going to stimulate demand, and you got to get more demand. It's going to cost. No, that's not going to happen. The Bank of Canada has to cut rates so much. Where you're taking a look at what the gap is between the origination of the loan to what's rolling over. They have to cut rates not just quickly, but substantially. And that's not going to happen too much over the near term. There's no get out of jail free card here. They have to cut rates so aggressively. But what lower rates will do will take down financing costs for the builders. The interest rates declines don't just work on the demand side, they work on the supply side. So taking financing costs down will overall help take construction costs down in that overall pie of what goes into building a home, the financing costs. And we'll get more building as a result of that. And that's another way that we'll restore some stability in the housing market. And that'll produce some downward pressure on home prices. But I don't expect that we're going to get a massive decline. You can't rule it out. The one thing I will say, and this is what's happening in Canada vis-a-vis the U.S. that's problematic, is how are the banks responding? How are the banks responding to the fact that we're going through a default cycle, a delinquency cycle, and a late payment cycle? And this is just a thin edge of the wedge, is they're cutting back on credit availability. They're raising their loan loss reserve provisioning, and they're constricting the supply of credit. That's why I am adamant that rates in Canada have to come down, because the supply of credit, the availability of credit, is making matters even worse. And it's going to create the conditions for not just disinflation, but outright deflation in the next 12 months.
I just want to bring up one point with regard to immigration. And this aggressive immigration policy that the government has adopted, is this the reason, or one of the reasons why the GDP per capita has been declining in Canada for the last 5 years?
It's a very interesting situation. The answer is that yes, but that's the house of cards that we have. The house of cards that we have, it'd be impossible to go into the counterfactual. But by definition, what it's saying is that without that population growth, the economy would be contracting at almost 2.5% in the annual rate. The problem is that we're bringing in a lot of people we've always been very generous on immigration, and we should be. But all of a sudden, what used to be a normalized level of 300,000, it's running 4 times that, but it's not paying for itself. It's for whatever reason, it's up to the government. This is the federal government is responsible for ensuring that the immigration ultimately leads to a more vibrant economy, more vibrant society, more vibrant economy. Now, I am not a social worker. I can't comment on, we love the fact Canada's so multicultural, so on and so on. It's always been that way. But the population growth, and it's only coming from immigration because we have fertility and birth rates at the lowest level on decades. It's not paying for itself. How do you run an economy where, on a per capita basis, there is no other way to measure your economic well-being than real per capita income and real per capita output, and it's declining. And here's the big problem. The big problem is that some countries may want to offset declining natural population by promoting growth in the capital stock and reaping the gains from productivity. That's not what's happening here. We've decided that we're going to camouflage a zero natural-born population growth with massive immigration. And even with all that, it's generating 0.6%, like microscopic real GDP, even with that. Telling you about what's happened with productivity. We promoted immigration well beyond the economy's potential to absorb it. And we promoted for decades, growth in the housing stock, not a productive asset. The housing stock is not a productive asset, but I've got to tell you something. In all those years I worked at Gluskin Sheff, all I ever got asked about was the housing market. I would go traveling in Europe and in Asia and in the States. Nobody talked about housing like in Canada. I always call Canada the Triple C economy. You know the Triple C economy? Right? Crude, cannabis, and condos. Not necessarily in that order. And so, but we're paying the penalty for it now. Instead of promoting growth in the productive capital stock, we promoted growth in the housing stock because it was politically popular, tremendous immigration, and also what is the fastest growing component of the Canadian economy is the government sector. If you look at the chart of the government sector share of GDP, it's doing this, and the business sector share of GDP is doing that. And of course, what does the government just do? They raise capital gains taxes on risk takers and entrepreneurs. But it's the corporate sector that builds the capital stock that leads to productivity. And that's the missing link in Canada right now, is the productivity. It's abysmal.
David, as we wrap up, you paint a very bleak picture of both the U.S. and especially Canada. But how would you suggest to investors that they construct their portfolios to prepare for this?
I think you want to be defensively positioned. So, that would mean having a lower percentage of your portfolio in equities than you normally would at this stage of the cycle. You'd want to be more heavily weighted in government bonds, which are detested and maligned. And whenever I mention this, people's eyes just roll. But you see, I'm a contrary investor. I love that. So we're recommending that bond duration gets extended, reducing exposure to equities. So in the equity market, to be really focused on the areas that are not cyclical, that have a low correlation with GDP, that pay a decent dividend. Dividend growth, dividend yield will come back into vogue, especially as the central banks cut rates and bond yields come down. People don't understand bond yield math, bond math, that if bond yields come down 100 basis points, the convexity is so powerful, the capital gain. People say to me all the time, why would anybody want to buy a bond, the 4.5% coupon? Well, you're buying it for the capital gain. People don't understand that 100 basis point decline, your 4.5% bond today is going to be worth so much more a year from now when you won't be able to get it anywhere. They're going to make 20 to 30% in government bonds in the next 12 months. You'll make equity-like returns in the bond market. And what I find is that everybody understands equity math, but they don't quite understand bond math. But that's one of our high conviction calls. We do not believe that the business cycle has been repealed. We do believe that interest rates matter, but they hit the economy with long lags. It's happening in the States. There was another long lags back in 06 and 07, 08. The cycle's the cycle. And this is not like, I tell this theme and this forecast to people. I've been doing this 40 years, and I know that look I get. The look I get is when I talk about recession. It's like I'm saying, your kid is ugly. That's the thing is that it's not personal. It's like the line of The Godfather, right? It's not personal, Sonny. It's strictly business. But I think that we should definitely be taking out the umbrella and moving to more defensive posture. I think if you have long-term thematic thinking, we like Japan a lot, secular tailwinds in Japan, secular tailwinds in India. And in fact, emerging markets are screening very well to us right now. And I would say, by the way, long-term growth in commodities. You want to have toes in the commodity market. It's one thing I'll say about Canada, not that we've done anything, it's our birthright, but there's commodities that are going to be related to the greening of the world and towards generative AI is a huge power absorber with those data centers, and that has links back to utilities and energy. And so I'd say commodities, and you'd say that goes against my recession call, but commodities may be the one positive surprise, even in a recession, looking at how powerful the supply demand attributes are in that sector right now. So you see, even from this, quotes, big bad bear, there's other areas to put money to work.
Well, that was a fascinating discussion, David, and I want to thank you very much for spending time with us today. If someone would like to learn more about you and your various services, where can they go?
Well, you can either Google Rosenberg Research, and it'll take you to the website. Feel free to surf the site. If you want to contact us and sign up for a 1-month free trial of everything that we do, just go to information@rosenbergresearch.com, and one of my client service professionals will get back to you right away and get you on the list.
Once again, thank you.
You as well.